Are you curious about the current state of the stock market and how you should navigate through its uncertainties? In today's video, we'll dive into an insightful analysis by one of the most respected voices in the investment world, Howard Marks, co-founder of Oaktree Capital Management. He'll share his thoughts on the overvaluation of the market, its cyclical nature, and offer practical strategies for investors during these unpredictable times. Let's get started. First, let's talk about the current state of the market. Howard Marks suggests that the S&P 500 is slightly overvalued, with the price-to-earnings (PE) ratio standing at around 21 compared to the historical average of 16. This indicates that stocks are relatively expensive, and investors are paying more for each dollar of earnings than they have in the past. High valuations like these can often precede market corrections, as overvalued stocks might not sustain their high prices when economic conditions change. Marks also emphasizes the importance of understanding the cyclical nature of markets. Markets move in cycles, consisting of periods of expansion, growth, and contraction, decline. Recognizing these cycles can help investors make better decisions. Marks believes that we're currently in a middle ground, where the market is slightly above fair value, but not excessively overvalued. This makes predicting a decline less certain, but it's still a precarious position. One of the critical indicators Marks highlights is the role of interest rates. Central banks worldwide adjust interest rates to manage inflation. Higher interest rates increase the cost of borrowing, which can slow down economic growth by making loans more expensive for businesses and consumers. This slowdown can reduce spending and investment, potentially leading to a decline in stock prices. For investors, rising interest rates signal a need for a more cautious approach, as the higher cost of capital can lead to a reevaluation of asset prices. Now let's consider some practical strategies based on Marks's investment philosophy. Marks stresses the importance of risk management, which involves taking intelligent risks rather than avoiding them altogether. Avoiding risk entirely often leads to avoiding returns as well. To achieve superior investment results, one must be willing to take risks, but do so strategically. This means being aware of the risks, analyzing them, diversifying investments, and ensuring high compensation for the risks undertaken. Howard Marks also emphasizes the importance of understanding market cycles. Market cycles are the natural fluctuations that occur in financial markets and economies over time. These cycles consist of periods of expansion, where the market grows, and contraction, where it shrinks. Recognizing these cycles is crucial because nothing, especially involving human behavior, moves in a straight line. Just as the weather changes, so do economic conditions and market sentiments. During these uncertain times, here are some practical strategies based on Marks's philosophy. Firstly, understanding that markets move in cycles is a fundamental key. Marks notes that one of the biggest mistakes investors make is believing that once a trend is established, it will continue indefinitely. This misconception often leads to poor decision-making. For instance, if the market is rising, many investors might think it'll keep rising forever, leading them to invest recklessly. Conversely, if the market is falling, they might panic and sell at the wrong time. Midway through our video, if you're finding this content valuable, please remember to subscribe to our channel, Economic Hero. Your support helps us bring more insightful content to you. Marks argues that this straight-line thinking ignores the reality that markets move in cycles. Expansion doesn't last forever, and neither do contractions. The reversion to the mean is a key concept in understanding market cycles. When markets or economies are extremely high or low, they tend to revert to more average conditions over time. For example, if the stock market is performing exceptionally well, it's likely to eventually experience a downturn. Conversely, if it's performing poorly, it's likely to recover eventually. This tendency for extremes to correct themselves is a fundamental aspect of market cycles. In his book, Mastering the Market Cycle, Marks explores why cycles exist, despite the economy's consistent long-term growth. The answer lies in human behavior. When times are good, Businesses and investors become overly optimistic, leading to excessive investments and overproduction. This can cause imbalances, such as too many factories being built, which eventually leads to economic slowdowns. When the market overheats, corrections occur to bring the economy back to a more stable state. Greed and fear drive these cycles, creating waves of optimism and pessimism that are reflected in market movements. While Marx is skeptical of precise market forecasting, he acknowledges that understanding where we are in the cycle can offer valuable insights. During times of extreme highs or lows, forecasting becomes more feasible. For instance, when the market is in a bubble, an extreme high, it's more likely to burst. Similarly, when it's in a severe downturn, it may be poised for a recovery. However, predicting the exact timing and causes of these changes is much more challenging. Marx suggests that making forecasts should be reserved for these extreme situations rather than attempting to predict market movements during more stable periods. In examining the current market, Marx notes that while the S&P 500 might be slightly overvalued, this does not guarantee an imminent decline. The market's value is just one indicator, and it's important to consider the broader economic context and the inherent unpredictability of market movements. In Marx's view, AI stocks might be experiencing a bubble of excitement, while the Chinese market could be undervalued due to widespread negative sentiment. Recognizing these extremes can help investors make more informed decisions, though it is crucial to avoid betting too much on any single outcome. Sound risk management is another crucial strategy. As articulated by experienced investors, risk management is not synonymous with risk avoidance. Avoiding risk entirely often leads to avoiding returns as well. To achieve superior investment results, one must be willing to take risks, but doing so requires skill and a strategic approach. The essence of sound risk management lies in the intelligent bearing of risk for profit, which involves being aware of, analyzing, diversifying, and ensuring high compensation for the risks undertaken. Howard Marks' Oaktree Capital Management has always prioritized risk control. Initially focusing on fixed income investments, the firm adopted the motto, "If we avoid the losers, the winners take care of themselves." However, as the firm ventured into aspirational strategies aiming for higher returns, simply avoiding losers was no longer sufficient. Nevertheless, risk control remains the cornerstone of Oaktree's investment philosophy, with every analyst and portfolio manager tasked with thinking about risk rather than relying on a separate risk department. Contrarian investing is another principle Marx advocates. This involves betting against the consensus. In every subject, there exists a consensus of what most people believe to be true. When the consensus is overwhelmingly strong, optimism about the consensus outcome is high, making the odds of betting on an improbable outcome compelling. In investment markets, the consensus is reflected in asset prices. Identifying moments when the consensus is likely wrong can provide opportunities to achieve superior returns by betting against it, particularly because the payoff for such bets is substantial when the consensus is incorrect. Being a contrarian investor requires more than simply opposing the consensus. It involves a deeper analysis, questioning the consensus, understanding the reasoning behind it, and identifying what could reveal its flaws. The process is not about routinely opposing popular opinion, but about thorough analysis and strategic decision-making. Significant profits are typically made by investing in assets that are out of favor and consequently undervalued. This approach was evident during periods like the internet bubble of 2000, where the prevailing justifications for high valuations were weak, allowing astute investors to avoid the subsequent crash. So, what is Mark's advice for young people interested in investing? His most important advice is to understand the prevalence of randomness in the financial world. You can't be an investor satisfactorily if you have to be right all the time. In investing, being right 60% or 70% of the time can make you the smartest person in the room. Investing should be seen as an intellectual challenge, similar to solving a complex puzzle with many layers. To succeed, one must be philosophically prepared to handle the ups and downs, learn from mistakes, and ideally undergo an apprenticeship under an experienced mentor to develop the necessary skills and mindset. We hope you found this analysis by Howard Marks insightful and helpful in navigating the current market uncertainties. Remember, understanding market cycles and employing sound risk management strategies are key to successful investing. If you enjoyed this video, please give it a thumbs up and subscribe to our channel, Economic Hero, for more valuable content.